I want to get to our Wrap the Week segment, which is our weekly attempt to make sense of these markets and take a step back a little bit and look at the long-term trends. I did want to start with a survey question that we asked you recently through our polling system. In your opinion, what's the biggest risk for stocks through year-end 2020? Hold on a second. Sorry, little a glitch on the title. This is which sectors are most likely to outperform over the next 3 months. Sorry for that. We gave you 4 choices: consumer discretionary, materials, technology, and energy. Technology number 1 with 60% of respondents saying that was the number 1 sector. That puts us through essentially mid-January through year end. Second place was consumer discretionary. Third place was materials. Fourth place was energy. So for 7% of you, I'm concerned that you thought energy was the best opportunity. You may absolutely be right, but as I've probably mentioned more than once, it's tough to think about the technical attractiveness of energy. If you're looking at energy, it's for something else other than the charts, I think, at this point, unless you're just looking for the biggest mean reversion ever, which again could absolutely happen. 60% of you saying technology, and I think if you look at the long-term performance of tech, certainly no denying it's been in the driver's seat on a relative basis over the long term, and it's a fair question. What's interesting, I didn't include utilities as one of the options, and today, utilities and healthcare number 1 and number 2, with utilities of relative strength really improving. We're going to look at that chart in a little bit, but I was just talking to the students at Babson College yesterday. I lectured virtually for them in the morning a couple times. And we looked at the example of 2009 to 2019. If you look at that 10, 11-year period, 2014 is right in the middle of a cyclical bull market, a secular bull market. And the question is, what's the number 1 sector performance-wise in 2014? The answer is utilities, which doesn't make a lot of sense. If you think about a cyclical and a secular bull market, you wouldn't think of utilities being being the number 1 sector, but it absolutely was. So, times like this, regardless of what you think about the market direction, focus on the actual trends, focus on what's working and what isn't working, and that's what's going to serve you well. Just very quickly, S&P finished flat after being relatively strong for most of the day. I was mentally prepared to talk about potential for follow through to the upside. We sort of came off of that thesis in the last hour as the week finished a little weaker than we might have expected. Mid caps and small caps actually, never really got much in the positive, and the small cap index was down about 0.6%. The VIX back higher above 27 today. In terms of bonds were down a little bit with the dollar essentially flat, and looking at commodities pretty much across the board weaker, with oil certainly driving energy, the sector lower as well. Let's look at our Wrap the Week chart, which is this one. And this is basically just a quick performance chart looking at the performance of some of the major asset classes since last Friday's close. And if you look here, the S&P is in black. These chopped around a little bit going into the close, but the S&P finishing around 0.1% higher than it finished last Friday. And with the sell-off in crude oil today, they literally finished the week with right about the same. S&P and crude oil right about the same. In terms of what outperformed this week, we had the dollar up 0.6%, bonds up 0.8%, the NASDAQ up 1%, and Bitcoin, the strongest of all of them, up 2%. And that's, I should note, Bitcoin came off a couple of percent today. It had been a strong outperformer up until then. On the downside, gold, the weakest performer, down 1.5% this week. Emerging markets down 0.6%. And small caps down 0.2%. So a couple things strike me here. Number one, not a lot of huge percentage moves. So we've had times where crude oil or Bitcoin or something is really an outlier relative to others. Everything's sort of in this sideways, choppy phase. There's no real clear, in the short term, breakouts or breakdowns. I would argue things have kind of come off of extremes. They're now sort of chopping around, sort of wait and see mode. I'm sure some will say this is waiting and seeing until the election, waiting and to see how coronavirus news evolves, and potential economic shutdowns and all those sorts of things. Maybe it's just a holding pattern until we get more guidance in one way or another. Expectations change, but I would say from a technical perspective, this is reasonable after the kind of moves we've had. Periods of higher volatility tend to be followed by periods of a little lower volatility as you digest. I always call them digestion moves. Kind of have the big move, then you have the digestion period where you process that, and people that bought or sold to get the price to where it is need a little bit of a downtime to figure it out. Other things I would note, the NASDAQ especially, if you look, Monday, Tuesday, Wednesday really was relatively strong, and you can see how it came off a little bit. So sort of this narrowness in performance going into Friday's close here. Let's continue on to the Mindful Investor Live chart. This is where we like to spend as much time as we can. Again, this process that we go through on Friday is part of my weekly routine. It starts on Thursday and finishes on Monday. I would encourage you, hopefully what this does more than anything is just accentuate the validity or the value of doing a regular weekly routine where you look at charts and whatever other information is important to you, and just have a consistent way of reviewing that information. Having said that, let's get to the first chart. So this is looking at the market trend model that I've followed for a number of years. We refer to this pretty regularly, and it looks at the S&P on a weekly chart and tries to address three major time frames: long-term, medium-term, short-term. Long story short, these are all net positive, all sort of long and strong, signifying strength. The long-term signal, buy signal or bullish signal came here in early June and has remained positive since then. The medium-term model turned positive here in early May and has remained positive. It was close to turning a couple weeks ago, and really even at times this week felt like it may do it, but has remained positive. And then the short-term read is simply looking at where the price is relative to the 5-week exponential moving average, just as a proxy for the short-term trend. I really like to use the daily chart for that more than anything, but overall, that's positive as well. So all three for the last couple of weeks have been positive, which is about right. When the market's at or near all-time highs, the trend following model should be consistently positive, and that's where we're at. Looking at the daily chart, so we've now, sort of stalled. I was writing a note to clients yesterday, and I went with the word hesitates as trying to characterize what the market's done. And if you think about it, we sort of came off of the all-time highs here, didn't quite get to 3,600, pulled back to the congestion range that I think makes a ton of sense from a technical perspective, this 3,200 to 3,250 range. We then came right back up above the 50-day, and now we're in that sort of margin of error of previous highs. We're 40 points away from the all-time high, which is about where if the market's going to top out, it certainly would be reasonable to do so, and you could consider that sort of a double topping formation. We broke down through the short-term trend line just using these recent lows yesterday, but closed higher. Today felt like we were going to continue this journey up, but essentially closed flat from where we were. So you had an up day yesterday and then the down day today, and they finished right about at the same level. So that is literally the definition of a sideways trend. We're essentially where we were last Friday after a couple little price swings. So overall, it's been certainly the sort of the pause. And the question, as always, is, do we resume the uptrend? Do we break down? And again, I think this is the time to pay attention to these recent price swings. As long as the highs are getting higher and the lows are getting lower on whatever time frame is important to you, I think that tells you about the trend. Looking at the trend since March, sort of taking a step back, you can see these major price swings of impulse moves and corrective moves overall. Higher highs, higher lows. We have potentially made a lower high, and the question is, I think the thing that really validates that as a distribution pattern is you break below 3,200, which means you have to come off quite a bit. Otherwise, we're sort of in this sort of toppy range. Let's continue on looking at the breadth characteristics. This is one area that certainly rotated from negative to positive very quickly. Here in late September, you can see that all the cumulative advanced decline lines for all of these different buckets of stocks had broken down. They all started to rotate higher. Two of them, the S&P advanced decline line and the mid-cap AD line, have broken to new highs for the year. And you can see I've colored them in green as they've broken out. Two of them, however, have been unable to do so. And the NYSE advanced decline line, the small cap advanced decline line, these are not updated for today's close, Friday's close just yet. By the way, they will here shortly, but overall, based on what I've seen, I'd assume that they'd be relatively flat from yesterday. So overall, you have two of them confirming further upside potential, two of them not quite confirming, and unfortunately, it's the equal weighted version that accentuates the small cap. So essentially, the large mid cap trade is working better than the small cap trade, and that has been the characteristic of the market at times, but it certainly doesn't speak to internal strength with the smaller end of the equity universe. The next chart is looking at new highs and new lows, and talk about a change from last Friday to this Friday. On last Friday's show, we were talking about this increasing number of new highs as more and more stocks were able to make new 52-week highs. At the peak, about 15%, 16% of the S&P on a single day made a new 52-week high. And again, the S&P has not yet made a new 52-week high in the last month. And so, for the market to be propelled higher, usually you have the leaders, the things leading the market higher, that are already triggering the new 52-week high, already getting above their August or September peak, and stocks like Caterpillar come to mind that are still, that are breaking out just fine. And you had an increasing number. And part of what we talked about was to feel better about the ability of the S&P to eclipse 3,600 and to move materially higher. You'd want to see a continued increase in new highs, because that tells you more and more stocks are pushing higher. That's what drags the index up with it. We've not seen that this week. You actually saw a rotation lower. So pretty much everything is in this digestion phase this week. So the difference from last Friday to this Friday is what seemed like unrelenting optimism has felt more like we've moved up enough. Now we need to take a little break. And the question that's totally reasonable, even if you're long-term bullish, that shouldn't, dissuade you from that thesis necessarily. But it does tell you we're sort of, in a pause before the next move. And my question, as always, is going to be what's that next move? And I think you look left on the chart to find the recent swing highs and lows to see which way we would break from there. When you look at the breadth conditions in terms of stocks above or below their moving averages, 73% of the S&P above their 200-day moving averages as of yesterday's close on Thursday, which overall is certainly in the bullish category. I don't see that as a negative necessarily, although sometimes the market has topped around those levels. But in an extended bull market, this can go above 75% and even higher and remain there for quite an extended period of time. So I think that on its own doesn't tell you that the market's topping out, but it is certainly a data point telling you we are at the point where either we start to pull back and or may continue to push much further. And so again, it tells you more than ever to pay attention to those support and resistance levels to see what holds or not. In terms of stocks above their 50-day, 70% of the S&P remains above its 50-day, which is more than half, which is relatively constructive. The challenge here is, again, as every time the market's moved higher, you've had less and less stocks going back above their 50-day moving average. That certainly is a bit of a concerning data point relative to some of the others we've talked about. In terms of sentiment, the one we usually use is the AAII survey. We talked about this yesterday, and I would just point out that, if I remember right, but I would point out that it's almost net positive, and it has not been net positive since February, which is actually quite a dramatic turn. Now, usually at a market top, when the market's at new highs, you would see bulls quite outweighing bears, and we have not seen that. In the market peak in 2018, just before that, you had a 45% more bulls than bears, and now we still haven't had bulls outnumber bears yet in the last 8 months. So it's certainly been an unloved market according to this particular survey. Other sentiment measures, especially the equity put call ratio, with which my guest Mark Newton was talking about on Wednesday this week, overextended. And I think if you look at certain measures of sentiment, that is one. The other one would be the Ridex flows as well, sort of at extremes. Only other thing I wanted to point out was one other chart, the relative performance of semiconductors. So anytime I start thinking about market tops, I look at the relative performance of semiconductors. This group has continued to do very well on a price and on a relative basis. If and when that changes, it just turned down a little bit going into Friday's close. But as long as that overall trend remains positive, it's hard to think about things getting dramatically worse. If that starts to turn, though, you will hear me start to get less constructive very quickly, because that's a bellwether group that tends to do well in a bull market phase. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.